every week for more than 30 years, America's most widely watched and trusted source of economic and financial advice, Wall Street Week with Louis Rukeyser, is made possible by Deloitte & Touche. Businesses have always had to face new challenges. Who can they turn to now that they face a new economy as well? For e-business services, the answer is the people of Deloitte & Touche. By A.G. Edwards. Committed professionals providing a full range of financial services and investment advice. A.G. Edwards. Trusted advice, exceptional service. By Oppenheimer Funds, where a long-term approach to investing has helped put financial security in the hands of millions of Americans. Oppenheimer Funds, the right way to invest. By the Kaufman Fund, a small company aggressive growth fund. And by contributions to your PBS station from viewers like you. Thank you. Produced Friday, April 6th. Our panelists are Mary Farrell, Louis Holland, and John Kim. Tonight's special guest is David H. Komansky, Chairman and CEO, Merrill Lynch.
Good evening, I'm Louis Rukeyser. This is Wall Street Week. Welcome back. Well, this was the week when we found out what really ails America. It's vitamin E deficiency, an undersupply of energy, employment, and economic growth, perversely combined with an oversupply of elections. In energy, the lack of coherent U.S. policy was painfully evident from the oil fields of OPEC, where the squeeze on crude pushed prices to a 5-month high, adding another weight to the faltering world economy, to what looked to many like the People's Republic of California, where environmentalism run wild had blocked the construction of the power plants the state now so clearly needs, and where the pretense of consumer protection, forbidding those nasty utilities to charge rates that would cover their wholesale costs, led today to the state's largest utility filing for bankruptcy and to the likelihood of very much higher prices for consumers. California's biggest blackouts appear to have occurred in its politicians' heads. In employment, always a lagging indicator since most companies tend to hold on to employees as long as possible, layoffs have now become more than a sometime or a silicon thing. In March, the U.S. actually lost jobs for the first time in 7 months, 86,000 of them, the largest monthly hit since 1991. And the unemployment rate rose to 4.3%, the highest in more than a year and a half. As for economic growth, even the Alan Greenspan Sunshine Boys from the Federal Reserve, who were dispatched all over the country late last month to tell people that conditions were much better than they thought, have now become notably subdued, as evidence mushrooms that the Fed was a wrong-way Corrigan in steeply raising rates, downplaying the possibility of a slowdown, and then being conspicuously tardy in moving to remedy its stubborn excesses. From the depressed manufacturing industries to the newly worried service sectors, calls increase for the Fed to cut rates again, deeper and sooner than the monetary authorities might have planned. But it was also increasingly evident that the Fed can't perform miracles all by itself, and that the congressional wrangling over a tax cut was causing angst from Wall Street to Main Street. And that's where that other E, elections, comes in. Given the historically close results of the 2000 elections and the practical fact that the Republicans now control the U.S. Senate in name only, both sides often seem to be looking more to November 2002 than to the immediate situation in the country. Ironically, beneath the political posturing, the economic case for a significant tax cut is now virtually unassailable. This is true whether you start from the left's traditional affection for Keynesian economics, which would dictate an immediate tax reduction to spur demand, or from the right's attachment to supply-side theory, which holds that high marginal rates and investment taxes throttle growth in both the short and the long run. But with the two houses now having produced markedly differing initial versions, even on the highly debatable and statistically dubious issue of precisely how much a tax cut would cost, it's now obvious that fiscal policy is even further behind the curve than monetary policy. So it's scarcely any wonder, as this vitamin E deficiency works its way through the national anatomy, that the financial markets have been delayed in finding a cure for the ills that have ravaged investors over the past year. As Adam Smith first reminded us more than 2 centuries ago, a nation can take a lot of ruining, and few would doubt that both the economy and the stock market will recover and go forward with renewed vigor. But exactly when that will happen, the doctor ain't saying yet. We tonight will talk with the boss of the biggest firm in all investing to get his views on where we're heading and whether there will ever again be a need for moorings for the customer's yachts. But first, let's look at the submarines. And as the Dow Jones Industrial Average indicates, the SIC stock market staged another of its now familiar one-day-in-a-row rallies on Thursday, with the Dow soaring more than 400 points for its second biggest one-day point gain ever. But amid renewed earnings warnings and the latest energy debacle, the Dow couldn't hold its gains and finished down more than 87 points at 97.91. That was still the best performance of any of the indexes, with NASDAQ wasting its third best one-day percentage gain ever in still another false start in a week that took the technology indicator back to levels not seen since October 1998. But you couldn't budge an elf. Indeed, we may have to build a nuclear power plant of our own to do that, even though a bearish vote would have been correct 3 months ago, since when the Dow has dropped nearly 9%. Their failure to catch the turn was even more conspicuous in our new competition to predict the NASDAQ as well as the Dow. NASDAQ tumbled nearly 40% in the past 3 months. And that, my friends, is no bull. Interestingly, while the Fed's fast-dwindling inflation hawks did their expectable tut-tutting over a 6-cent blip in average hourly earnings, that didn't seem to concern the bond market, which had its best day in 3 weeks, as the ghouls rejoiced over bankruptcy in California and the delightful reports of so many other people losing their jobs. And if worries over your sinking savings have led you to neglect a sensible diet lately, you might be interested in a study at the University of Toronto that suggested that eating a caveman's diet, just roots, shoots, nuts, seeds, berries, and leafy foliage, could help reduce bad cholesterol by as much as a third. Reminds me of the old story of the fellow who said to his doctor, "If I do everything you ask, no drinking, no smoking, no rich foods, constant exercise, will I really live longer?" And the doctor replied, "No, but it will seem longer." Mary Farrell, when will the market get back on a red meat diet?
This does seem like an endless bear market. It's been a year, which is long because we had all gotten in that habit. Prior corrections seem to, or even bear market seemed to end remarkably quickly, and we got back on track. I think what we need is visibility of earnings. And I point out something interesting about earnings comparisons is when you go into recession or you go into an earnings slowdown, it tends to last 4 or 5 quarters because the comparisons get so much easier. So by the first quarter of next year, we should actually have a pretty good gain, and next year should be a pretty good gain. So I think the market will look ahead and at some point this year price on that.
The Fed governors were pretty quick to tell us we'd have a recovery in the year's second half, and that certainly was the consensus a few weeks ago. Maybe not so much today. What's your feeling?
I think by the second half we should have a stronger economy, and I hope by implication that means that they will speed up some more rate cuts to spur that. You know, it's clearly unfortunate that we're not getting a tax cut very quickly, and hopefully it will be retroactive. But I think the Federal Reserve really needs to act much more quickly to get things back on track.
Yeah, the Fed funds market is predicting that maybe they will this time. So let us pray. Lou, Holland, what do you make of what's going on?
Well, I think that, again, I think the Fed is behind the curve here with regard to the economy. I currently think we're in a recession, and I think it's worse than most people think. I think the difference this time is we have an excess capacity type recession as contrasted to a consumer-driven recession. So it's a little bit different, but nevertheless, I think it's equally painful.
What would you do as an investor now? Would you be making sales, making purchases?
No, I think we're near the end of the bull market, and I say
the bull market?
of the bear market, but I think say that kind of selectively to the extent that I think the NASDAQ 100 is still not particularly cheap. It's still selling at about 48 times next year's earnings, and that contrasts to the S&P, which is about 20 times. I think the real excitement is in the smaller stocks, the mid-cap stocks. They won't do well when the overall market's correcting, meaning the NASDAQ stocks are correcting. But I think coming out, they will lead. So I think people should not be selling these stocks. I think at some point here over the next several months, we're going to get a rally in these stocks that are down 80, 90%. But I think that what will happen is people that own these stocks at 80 and they're now 20, that they will sell them into their strength.
What are some of your favorites now?
I like Chuck E. Cheese, CEC Entertainment. I like a little company called Ceridian, which is in the payroll accounting area. And I like a fairly large company called Lowe's, which is a home improvement company, which I think is now the best company in the space.
Chuck E. Cheese suggests that you wouldn't be eating the caveman's diet.
Not exactly.
John Kim, you've had more faith in technology than Louis had.
Yeah.
Has that faith been continued now?
I've lost the faith for now. There's no question that the new paradigm is not the new paradigm, that we are back to the more traditional valuation mechanisms. And what concerns me is I do agree with Mary's comment that on a year-over-year comparison, that 2002 earnings forecast should be better, and we hope that the market will reflect upon the more positive outlook for 2002. The concern that I have is I don't think that the slide in the reduction in either the earnings growth or the absolute negative earnings or losses is we've seen the worst of them yet. So we still need another quarter or two before we can see the full color of what the outlook is going to look like.
Is it too late in the day to sell any of these stocks?
I think so. I think it would be unwise, especially as Lou mentioned, with stocks down 80, 90%. I just can't see, if you haven't sold already, why you should be selling at these levels, that you will rebound. And the good news is if you're down 80% and it goes back up to, say, from 20 to 30, you're going to be up 50%. So the magic of the percentages on the way down and the up should soften the blow a bit.
What do you like right now?
I like that stock called Cash. The symbol is CASH. I
thought that was illegal.
That was. I would stay with the value-oriented stock at this point from a pure defensive perspective. There is still a fair bit of M&A activity in the financial services industry.
A couple of value examples.
Lincoln National is a good safe bet, and American Express had a tough week, but I think it's at a very good valuation level.
Okay, we'll have to card you later. Never fear, though. They can't scare us. We'll be standing by for you as usual here at the Financial First Aid Station at Owings Mills, Maryland, 21117. Tonight it's time for me to let you in on one of our very special annual events that's coming up for you 3 weeks from tonight. Our 12th annual induction into the Wall Street Week with Louis Rukeyser Hall of Fame, an elite academy that now includes 21 of the people you have told us were your all-time favorites from the past 31 years on this program. Malcolm Forbes, Peter Lynch, Merrill Rukeyser, John Templeton, Frank Cappiello, Carter Randall, Milton Friedman, Julia Montgomery Walsh, Marty Zweig, Bob Farrell, Monty Gordon, Wolfgang Demisch, Charlie Maxwell, Henry Kaufman, Mary Farrell, Bob Stovall, Ed Brown, Abby Joseph Cohn, Julius Westheimer, Laszlo Barini, and Sandy Weil. And so our question for you tonight is, who should the next inductee be? As always, the decision of the judges will be final, but we want to hear from you before making that decision. So here's your chance to nominate one or more people who have stood out in your mind in their appearances on this program and who, in your judgment, deserve our very highest accolade. So let us hear from you now with your nomination for our Hall of Fame. You can visit our website at pbs.org to see all 21 current members.